All right, hello and welcome everybody. We are live. Well, as a form of introduction, my name is Jonathan Wu. I'm head of the marketing team at Master Capital Group. Now, we are already in the middle of March, almost 2021. It has been a great year so far. I hope you're all having a good year so far. Just again, a form of introduction. If you may ask, is this a good year to start investing, renting, buying, developing properties? Well, let me give you a little bit of a heads up on the market updates. Well, the Australian home values continue to grow in February 2021, leading to the largest month-to-month improvement in almost 20 years, according to the CoreLogic. And then another one, recently the RBA sort of dropped their rate or maintained their rates at 0.1 of the percentage point, and looks like it's not going to increase anytime soon. If prediction is 2024. Again, another highlight sort of mentioned there that the housing market is booming, fueled by extreme low interest rate environment and fiscal stimulus. Again, the economy is picking up. The COVID vaccine is already in, basically. So one of the last one here, well, it's sort of a bit of a laugh there. Last year, the bank sort of predicted there'll be a 30% drop. But recently, the Commonwealth Bank sort of came out boldly and mentioned that, well, there will be a rise, 16% for houses. So as you can see there, well, is it a good time to start renovating, investing, developing? Well, the answer will lie into the next presentation that we're going to have for you. So now, first of all, I'm going to again welcome our guests. Just to say a few words this morning. First of all, I have Chris Reid from the Business Concepts Group. Welcome, Chris.
Thanks, Jonathan.
Well, good to have you. And of course, our very own Managing Director at Master Capital Group, Peter Hutchinson. Welcome, Peter.
Good morning, Jonathan. Well, actually, good afternoon. Thank you for having us and putting all this together.
Yeah, correct. Well, either good afternoon, good morning, or good evening, and not good night yet, whichever time zone that you're dialing in. I know that there's one person registered from the UK. So, welcome. I'm sure there'll be a few from Hong Kong and a few of our investors, from that region as well. Welcome. Lastly, we have Tesla Lee, not from Elon Musk, but this is our very own Tesla. Welcome, Tesla.
Thank you, Jonathan. Hi, everyone.
Tesla will be monitoring the comment in the chat room. So if you have any questions, feel free to put in the chat there. We're going to have the Q&A at the very end of the session. Now, before I let the guests take over the stage this morning or this afternoon, I'd like to sort of read out the disclaimer. It basically says that the information provided in this presentation is general only. And of course, you should seek legal advice and speak to your advisor. But if you are in doubt of anything, want to get in contact with Chris himself, feel free on the email provided there, or with Master Capital Group, you can do that as well. All right. So this is one of the many series to come. Today it will be just an introduction. So what I do is, further ado, I would like to let Chris and Peter take over the stage and start your conversation on the topics. All right, now let me just remove the rest of us out, and then Peter and Chris, please take over.
Great, thanks, Jonathan. Thanks for the introductions, and welcome on board, Chris. It's an exciting day to talk about property and developments and counting and all things from like the masterclass that we're going to go through. I think it's an exciting period of time that we're going to, this year is going to be a challenging year, but also, with the right forms and the right structures in place, I think there's a lot of room for growth in property development. So maybe I thought maybe a little bit over to you, Chris, and a little bit about business concept groups and what you do, how you help your clients, a little bit around the masterclass. We can talk about that as well. That's a privilege that I have that I get to talk about on structures and things like that in AFSL side of things. So, Chris, over to you.
Yeah, thanks, Peter. Thanks for having me along. Yeah, just very, very quick intro to Business Concepts Group for those out there who don't know. We're accountants and advisors by trade. We do have a specialty in advising property developers. We've also got a specialty with self-managed super funds as well. So we do a lot of work with property developers around structuring and obviously all the tax issues, all the things you'd expect accountants and advisors to do. But also we extend out to our professional networks as well, our Master Capital Group, all the legal firms that we do work with that specialise in property development, helping with feasibilities and lending and project funding and all the other things that go along with it. So that's very, very quickly what we do. And obviously, yes, we both present at the masterclass, which is always good. Unfortunately, couldn't run last year because of the COVID, and certainly looking forward to getting back in there and being able to talk to developers and present at that one again.
Yeah, I think that's one of the parts that I enjoy the most. Even and I'm not a huge presenter, but what I do enjoy is the openness and transparency that comes through. And we have some really good. Last year, the year before, we had some really good, frank discussions with, there was investors in the room, there's developers in the room, asking good questions that, the group of us combined with all the expertise that comes through, whether it's capital raising on our side or AFSL compliance and making sure that the funds are being raised in the correct manner, or on your side from accounting and, and obviously structuring, and I know I say it before, and most people who have dealt with me will hear it again. But begin with the end in mind. Why we talk to you as an accountant and a professional in your area is to make sure that the company and or the structure or the trust or whatever is required is set up correctly, so that the beneficiaries of it, being the shareholders and so forth, will enable them to make good decisions right from the start, rather than ad hoc later on that may cost them if they're transferring land or stamp duties and land duties and that sort of thing that often get missed. And I know this is only a part of a mini series that we're going to put together for a number of topics that Chris and I will cover off, and maybe Dominic as well, in terms of working through how the masterclass and all the different topics. And this is only a short version, so I'm hoping that everyone will get some benefit out of this, and that we'll engage further to see how we can help both clients, whether it's Master Capital clients or BCG's clients as well. If we can help along the way, then that's kind of a fairly important task of what I enjoy as well. And there's obviously a number of different projects that we're working on, but maybe, Chris, do you want to run through just a brief version of the masterclass and all the different topics that you're going to cover? And we've also got question and answers which are available through, which we'll cover off at the end. So if anyone who's listening wants to ask any questions, please just forward them through in the question and answers box there, and Tesla will take care of those and ask them towards the end.
Yeah, so I mean, a couple of the key topics with the masterclass is around structuring, which is one of the topics which we'll have a bit of a chat about today. Also, that capital raising, which is a key component. But one of I think the real pluses to the masterclass is the topics that are aren't covered in depth in a lot of other property development courses. Now we look at being development ready. We look at structures, taxation, all the legal issues, capital raising, lending and funding. So it's really a lot of the foundation work that really supports a development. So it's not so much doing the development itself, it's all the other stuff which is just so important. I guess the structuring is where we start, as you say. It's starting with the end in mind, and when we sort of flow through from there. And it's one of the big questions we always get is, what structure should I use for my development? And it sounds like a simple question, but there's just so much detail in providing that answer. Everything from asset protection to taxation issues. What do the investors require if you're bringing on investors? What do the lenders require if you're bringing on lenders? And ultimately, what are the project outcomes that you want? So if you're sitting down and looking at your structure requirements, what's the end result going to be? Are you are you developing and selling them all? Are you looking at holding some as a rental property, holding them all as a rental property? Maybe there's going to be a principal place of residence as one of the units and you want to keep that, or a combination of all of those. And sometimes different investors have different outcomes as well. We see developments get done where one group of investor wants to hold the property, one wants to just build and sell, one might pull out a principal place of residence. So there's all these combinations in there that really start to drive the actual structures themselves. And that's before we even sit down and talk about, okay, is it a company, is it a trust? What are we sort of using there? So, and as you mentioned before, stamp duty issues that can pop up if you get it wrong, making sure that you sit down and work through. You don't want to have to change ownership partway through and trigger stamp duty issues. You don't want to change beneficial ownership or equitable interest, as the State Revenue Office calls it, partway through. You know, for example, starting to split off and do profit shares and those types of things can trigger stamp duty and double stamp duty. So, you know, I guess that's sort of a very, very quick overview of some of the structuring issues that we do see, and that, you know, that's one key topic of the masterclass that we do go through in a lot of detail.
I think it's really cool. You know, maybe tax and accounting isn't cool to everybody, but at the end of the day, that's what you're going to end up with, is how much you end up with at the end of the project. And just structuring it's such a diverse, you know, area that, you know, it encompasses so many different positions from different what they're currently in, whether it's a subdivision, whether they're retaining land, whether they're on selling the land, what year they're selling it in. All those things are critical to what the outcome is. And although you may not think at times, you know, that, oh, we'll just sell them all. Well, maybe selling them all in one financial year compared to the, you know, over a 2-year period will make a significant difference depending on incomes of those particular years. But you know, again, I'm not the tax side of things, but I've looked at these sort of things, and because of my background, I'm always getting asked those questions. Which fortunately we've got, you know, Chris, you know, you can answer those questions legally better than I can, you know, and so I look for, you know, we've got a good group of people that specialise in certain areas. And, you know, and this is one way of being able to bring it to all the whether it's an investor and a developer. It's just as important that the investor understands what the developer is trying to do as what the developer is trying to understand what the investor wants out of it. So coming to a middle ground, or whether it might be an ASIC issue, you know, whether capital raising and how you're going about it. You know, once it becomes a public document, you know, obviously you need to be licensed. You know, but there's a lot of people who've just raised capital who haven't gone down that track, and unfortunately, you know, they end up getting caught, or not courts per se, but, you know, if ASIC steps in, they just take over the project, whether it's running well or not. And that can imply, even when you're looking at structuring, whether you are giving, and loans. You know, just recently, I looked at a loan. Well, I'm doing a loan now on one of our projects where they tried cross-collateralizing through a shareholding agreement. Now, most people don't pick it up, and it's not until the very end do you realise that you actually give a shareholding or beneficial ownership rights back through to that entity, which opens up the whole project. Now, fortunately, we read the documents, and it's an eye for detail in that area, and we made sure we removed all those sort of things, because every lender, and it doesn't matter how you put it, but every lender will try and maximise their position and take security over everything that they possibly can. But it's often a small area that is overlooked by developers themselves. So begin with the end in mind. There is just as much work in the front half of it before you even turn, you know, going to councils or planning, in terms of making sure you're set up structurally correct. Because one, you know, if you don't, for argument's sake, your stamp duty, like, you know, where you mentioned, is, you know, if you start changing ownership, you're up for stamp duty again. Well, stamp duty at 5.5% roughly, you know, it starts adding up, you know, or if you're putting in an application into council, you know, when have you had beneficial advantage, you know, when is the actual asset realizing a better value. So lots of things that you've got to consider prior to actually starting the development. And you may have some investors, you know, there might be a developer that has some investors that are interested in backing that particular developer. However, they might not have all the funds. Well, that's where, you know, we can sit down together, work out a way of structuring it so that the income that's coming in, or the equitable interest that comes in, may come in via debt, but you'll need to think about how that comes in as well. And then whether we raise capital or whatever for investors, with investors to go into developments, whether it's a joint venture agreement. And you talked about profit share, Chris. That's a ripper. And I know and you see it time and time again where you have a developer just say, "Oh, we'll give you profit share." I've seen it with working with real estate agents. Typically they want 50% up front if it's off the plan, or there might be a beneficial interest so that they actually have, we'll take some profit share at the back end of it and reduce our sales costs. Well, that's fine, but then they're deemed, they may well be deemed as beneficial owners, in which case if you change your, whether you change a development manager or you change a real estate agent, if there's some beneficial ownership, then you're changing ownership of the trust or the company that it's set into. So there's a fair bit of work prior to starting it, and whether it might be writing an IM, which from an accounting point of view is critical, is to verifying that the what you put in an IM is actually true and correct, that you do have all the backup supporting documentation that then protects the developer essentially from themselves as well. So if they're not just making up a story and saying, "Oh, I believe that this is a good project," they're actually backing it with facts. And whether you get them, how you get them, all those things can be verified by and have legal sign off on it. Reduces your risk as a director in that entity, which also again gives confidence. And you might think it's a minor thing in terms of having verification, and yes, it does cost a fair bit to do a verification file. However, the benefits sometimes will be as simple as going to a lender, and the lender will then look at that very favourably because they know that a lawyer has signed off on everything that's in it is true and correct. So it's sort of the underlying thing, the benefits that you can get from doing an IM correctly as well. But more, probably a little bit more for Chris. How do you see with the masterclass and maybe some of the topics that we can talk about structuring today is something that you would like to expand on?
Yeah, I think we've sort of already touched on the importance of it, but I think that getting it right from the front end and making sure that you don't make simple mistakes that are easily avoided. Things like double stamp duty, if you're changing beneficial ownership, changing ownership partway through, even your and/or nominee contracts in Victoria, if you're out, starting to do planning and sort of some of the development work can trigger double stamp duty. So simple mistakes like that we see a lot with developers, especially inexperienced developers. A double stamp duty takes a big chunk of profit out of your project. Simple mistakes around GST as well can take a big chunk out of it. Even just things like not factoring in GST and tax into your cash flows and your feasibilities and everything as well can start to give you an incorrect view of how the profitability of the project and whether it's worth doing or not doing as well. We see developers make mistakes around GST as well. You start to take GST out of the returns on the project. Once again, maybe the project's not starting to look so good. So really getting it right from the start. And we've already mentioned about what are the outcomes we want from this. Taxation is often a driving force for people. And yes, it's very, very important to get your structures right. We want to minimise tax whereas we can. And that's where we start to use the different structures. We start to use companies. We start to use even self-managed super funds, which I'll come back to in a moment. But also making sure that we factor in the other elements as well. Well, we want to factor in asset protection. If we're going to be raising equity, well, what are going to be the requirements of the investors and how do we need to structure it for their purposes? If we're going to lenders, once again, we need to make sure that we're structured it well so that the lenders are going to understand things. And I'll just come back to the self-managed super fund thing. We get a lot of questions from developers about using superannuation and self-managed super funds in developments. And the short answer is yes, you can. But the complications around it need to be stepped through. You need to make sure you get the right advice around the structures, but also around the superannuation laws and where we can use SMSFs and where we can't. What are there going to be, if we do use an SMSF, what are the restrictions around that? Is that going to restrict us from borrowing? Is that going to restrict us in other areas? We don't want to breach any of the compliance regime around self-managed super funds because we could be forced to have to sell the asset from a compliance and a regulator's point of view. Maybe we're going to incur a heap of penalties that we didn't factor in. So it's just so critical to have a look at it. So, whenever we get asked those simple questions, what structure should I use for my development, or can I use my SMSF? Well, there's a very simple and short answer, but the reality is going through all these factors that we're touching on today to making sure that you actually get the structures right for your development from day one. And look, I guess one of the other things with developers out there, they all like to change their minds, right? So it's all very well and good to go through, and we go through a scenario and we map out a structure, or maybe we've even set up a structure to suit a certain scenario, and then partway through the project they change their mind, right? And that structure may no longer be suitable, and we might be looking at either having to live with what we've got or looking at a restructure scenario, which of course has costs and things associated with it as well.
Yeah, I think there's like I know I look to the sky sometimes and you hear about this is their idea from a developer, but they don't follow through with it. I think if they're more aware and sitting down collectively and more often with with your accountants, like your developers that are coming to you, coming to you 2 or 3 times a year is only the beginning. And look, I know we deal with you every month because you do all our accounting for our Hutchinson Street project that we're doing, which was an introduction through you as well. So, the client, 3PPG, they were great. They're still working with us now. We're raising capital and the projects we're working on, but that's not just the project. In terms of the GST, particularly from a lending point of view, understanding that that's a critical path as well, because virtually none of the major banks or the lenders will lend for the GST component. So who's funding the GST component, particularly when you're starting the construction, or maybe sales comms? Most of them don't allow for sales comms to be paid part way. So if you've just signed up an agreement with your real estate agent where you pay half now and half later, well, who's paying for the half? Where are you getting it from? And are you considering that up front? So your feasibilities, whether you use a state master, which we like and use a lot, but whether you use a state master or not doesn't really matter. But can you see how you're going to fund and your cash flows through it, which are really critical paths? Are you allowing for VCAT hearings? Because chances are in Victoria, or at least anyway, most of the time you'll go to VCAT. So if you're changing it, it might not. If you're changing it like for like, you may not. But a majority of anything you're doing major developments, then you will. So allowing for funding, allowing for application fees, things like that, in particularly with senior debt and or funders, is you need to fund that up front. So how are you paying for that? Have you got the cash flows? Have you got the investors? Whether they've come in through debt or equity, whether they may have come in through preference shares, and there's a whole list of ways of bringing funds in. But think about it before you start, and think about it for the entirety of the project. Is not just the beginning. Do we need $1 million that we're going to buy a $5 million asset? Well, where's the rest of it going to come from when you actually need to settle? Option contracts, that's another classic one, and your stamp duties and change of ownership once you've, if you've applied to council, for argument's sake, and you've already made a gain on that property simply by applying for council and going through that direction for plans and permits. So there's lots of areas that we can further expand on, and I think over this series of webinars that we're going to do together, I think investors and or developers will get a lot out of it, and continue to. It doesn't matter, it doesn't matter how old I am, and I'm still learning. Every week, every month, there's always something. Oh, that's a different way of doing it, or maybe there's a better way of doing it, or and every project is different. You could get the same whether you do 10 apartments, whether you do 20 apartments, or 5 apartments, or townhouses. You could do 5 this year, 5 again next year, and the structure will be different. You might be doing joint ventures with the landowner, for argument's sake. Well, there's some serious consideration in how that is going to be perceived from State Revenue Office. And more often than not, and last year, the year before was a big example. We had a number of developers coming to us saying, we've been hit by State Revenue Office for double stamps. So had they have thought about it right up front, would have had a major impact on the their additional finances they need coming into the next project.
Yeah, that's right. And I think, look, you're right what you're saying about the feasibility and those common mistakes people make in the feasibility. Getting that right from the start, obviously, so you can assess the project. But that just drives into, okay, well, how much lending can we get, which is related to how much equity do we need to raise, right? So it's all sort of related there. And one of the big mistakes that we see developers make, and you see it as well, Peter, is around the misconceptions around capital raising and the need to be licensed to do this. And you might want to expand a little bit here around, I guess, how critical it is that people don't cross that licensing line. And I think the other thing which you might want to comment on too is around the misconceptions around the exemptions. Everyone shrugs their shoulders and says, "Oh, there's exemptions. I'll fit under the exemption," or in my assessment, I fit under the exemption.
Yeah. And I think in regards to, well, there we go. Thank you, Jonathan. So, we can talk about the 2-20-12 rule, and I can basically brief you on that. And, where you've got up to 20 investors over a 12-month period and up to $2 million. The fact is that, yes, you can, but no, you can't. And so the answer is you still need to be licensed. So it doesn't matter whether you're trying to raise capital. If you're managing someone else's funds, you need to be licensed, or have raised the funds through whether it's a managed investment scheme, and that can be registered through ASIC as well, or it can be a case of bringing debt in, but making sure that you're using someone who's licensed to raise the capital. Because once you're out there advertising, you put something on, whether it's social media, Facebook, or anything else, looking for investors, applying for investors, giving whatever the percentage rate is, you're deemed to be an investment manager and you need to be licensed. So, and given the Royal Commission, now that might be a little bit vague in a lot of people's minds now, but 2 years ago when we had the Royal Commission, there was significant amounts, over $2 billion that ASIC has now received towards finding and or punishing people who are not doing the right thing. And we will see that over the next 2 or 3 years. ASIC are reasonably, there's a lot of people working in ASIC and they move relatively slowly, but they do, and they've got the hindsight is probably the biggest thing with ASIC, is that they can come back, doesn't matter how long they want to go back. If they want to go back 5 years, they will, and they can then, the causes of not raising capital the right way right from the start will be evident, because you won't have, you might not have minutes of companies. You might be the director of the company, and sometimes that's taken a little bit too lightly. If I be a little bit blunt, I suppose, is that, yes, I'm the director of the company. Okay, well, have you taken company minutes? And how the decision-making process? Do you have a board on your directors, or do you have a group of people that you can actively say, yes, well, here's evidence. I went to my accountant and I got Chris to review this statement, and I got my legal advisors to do this as well. So,
just one more to finish off there. I know we're running out of time a little bit, Peter, but comments, because another one the developers always will throw up and say, oh no, they'll either try and tap into the 2-20-12 either incorrectly, or they'll just throw up and say, no, I'm just getting money from my friends and family. It's okay. I don't need a license, right?
Well, both you still needs to be licensed for. If you're using other people's funds, there's no tolerance or lenience towards it. It doesn't matter whether they are family, friends, or whether you're joining a joint venture. If you are in control and they're in a bank account that you control, then you need to be licensed to raise that capital. So, and you're right, Chris, we hear that a lot, and it's not until afterwards, we just lent them some money, or maybe we put it in, we were shareholders in this company, but the structure wasn't set up correctly in the first place, so that when you move it from a company back to a trust, if they want to be unit holders, for argument's sake, in a trust, are we changing the beneficial owners? Oh, we didn't think about that. We just put and/or nominees onto the sale of the contract. Think about it before you go down the track, because you need to make sure that the and/or nominee part of it is has it got the ability to raise the capital and/or invest into.
Yeah, and the other one is probably where it's called a loan, but it's profit share, right? So having a look at the substance behind what people are naming the transaction. Oh yeah, it's just a loan. It's just a loan, but I'm getting a 20% profit share. Okay, so straight away you've crossed the line into an equity space there. which has a lot of repercussions, one of which is the licensing regime.
Well, it's a beneficial equity, position. Sorry, Tesla, we're
Oh, that's all right. That's all right.
we've got a few questions, and Tesla, have you got a few questions that have come up?
Actually, the first question is actually for Chris. We do. Someone actually have a question saying that someone based in New South Wales. Is that okay can we use Chris service? Is that possible?
Yeah, absolutely.
Okay, and I think the more like the another question is more like are you familiar with the New South Wales kind of a taxation kind of like so that he can actually engage your services?
Yeah, absolutely. I mean, yeah, each and this is where it gets tricky in Australia because we've got all these different jurisdictions, and a lot of the stuff is at the Commonwealth level, which is tax and GST, the licensing regimes and all those types of things, and then state by state is where we start to dig into stamp duty and those types of issues. But yeah, we're certainly across the different stamp duty regimes in each state. Most of them are reasonably similar, but at the same time, there's always differences that we've got to deal with. So once again, it's dealing with that particular project. What are you trying to do? And providing the advice around the outcomes and that particular project and the uniqueness of it.
Oh, excellent. So maybe actually have another question is that do you think you can explain a little bit difference between the trust versus the company, the structure?
Very, very quickly, there's a lot more detail to this, which I think we're going to do a separate episode, which will be completely on structuring itself, and we'll go into a lot of different types of structures. Look, really around companies and versus trusts, the big one, I guess, from a taxpayer's point of view is the taxing point and the way that operates. There's a lot of differences as well around with stamp duty and changes of ownership depending on the state. So we tend to get a little bit more leeway with changing in ownerships of companies versus trusts and not during double stamp duties depending on the states. And also there's some differences around some of the legal entities versus non-legal entities as well. So it's probably a question that I could take half an hour to answer, would need half an hour to answer it properly. But really, in terms of your structuring and whether you're going to use a company or use a trust or a combination of that, it comes back to what we were talking about earlier. It is really around, okay, yes, we're going to address asset protection and taxation. Is there investor requirements? What do the lenders require? But also we want to start to have a look at the outcomes of the project as well. Are we building and selling? Or are we building and keeping? If we're building and keeping, generally we start to lean towards trust because we start to get capital gains discounts down the tracks and those types of things versus building and selling. So yeah, I would answer that at that in this short manner at that way, but certainly need to get detailed advice on making the decision between using a company versus using a trust.
Okay,
we could spend a whole day just on structure.
Yeah,
that's right. Correct.
Okay, cool. Well, so I think the next question is for Peter. So I think someone probably has a question. Is what are the current projects you are actually working on? And I think from the investor actually point of view, what sort of returns that after the COVID, would there be any kind of like any changes in terms of the investor actually the expectation?
Yeah, there's been that's an interesting discussion point, because where investors sit, typically they're looking for an interest rate or that type of return. And there you go. And these current projects that we're working on are typically somewhere 12-15% returns, depending on how the investor comes in. But it's also notable that some projects, if you're taking an equitable position, yes, you can get a higher beneficial rate. So the difference between an equity position and maybe a debt facility is that you'll have a debt facility that has a fixed interest component, and usually that's a bit lower. And now that talking to accountants and various fund managers as well, that there are funds coming into, a lot of people sat on their hands last year, which will drive. They've been sitting at 1% or less for term deposits. now they've all of a sudden realised that they don't have, if they're relying on them for a pension, they're only having a very small portion that is going to return. So they're looking at more diverse ways of investing, and often in property, which is, I'm not a particularly, even though we're licensed in securities, so we can talk about it, but talking about shares in the share market, that's not my, I like property, I love property, it's controllable, you can make changes to the entity, to the, whether you're building, in this case, Mont Albert, it was one house, we're turning into 7. Brunswick had a factory on it, and we're turning into 10 apartments and say a ground floor commercial. Q had a house on it, now we'll have 5 luxury places on it. So there's all different manners of how we bring into it. And fortunately, the Brunswick, which is the one Chris and Dominic, we have on a finance level, we actually make sure that they're all the bills getting paid and those sort of things are critical. And Chris does the GST componentry. How often you do, again, back to the GST again, well, you do it quarterly up until you start construction, and then you do it monthly from there on. So, sorry, did that answer the question? In terms of, the investors, there are funds available, and the investors drive, how they want to, their perceived timeframes of what they need to invest into, and the securities. A lot of people like the security of property rather than the lack of security in shares. You're not in control of the outcome of anything in shares. At least in property, you have a stronger ability to influence the outcome.
Okay, cool. Well, someone actually asked a question, is what actually motivate the investor will invest the money into the master capital? Like what are the differences? What will be the key differentiations? The master capital group different from the others.
Good question. Well, I suppose the first thing is that we're licensed. And if nothing else, if an investor doesn't take licensing seriously, ASIC only have the ability, if they find a developer raising capital or raising funds in an incorrect way, their only ability to ASIC has is to close the company and put it into receivership. So the asset will be sold, and more than likely the equity position or the lender going into any one of the entities, the builder or the development manager may have done nothing wrong in terms of the project itself. It might be running on time, everything might be taxes being paid, clients being paid, all the various components that, whether it's town planning or whatever, they might all be paid. So no one's actually in breach other than the fact they raised capital incorrectly. So if ASIC got involved, and from our side of it, that's why we hold a license. And yes, we pay dearly for it, and we hold it, every year. And we haven't, to date, we have not done anything wrong. There hasn't been any investigations or anything like that. Where because we go back to ASIC and we're talking to them regularly about what the compliance is, and making sure we're taking company minutes and those sort of things that are critical when it comes to the capital raising. Having more than 2 people to sign off in Wilkinson Street, for argument's sake, we have the development manager, ourselves, and Dom, who does our accounts with BCG. So he sets the payment up. So no one person has access to funds that can walk away with the funds. If an investor wants to invest directly with a developer and they give them the funds, yes, there's all trust coming into it. I'm not saying that every developer or any developer that's particularly bad, but they have the ability to walk away with it. And unfortunately, in the news, you will hear it from time to time where the developer's done the wrong thing. We are forced to do what we do in a methodical manner. We tick off ACN numbers and we check all the back end of it to ensure that each invoice comes through is actually correct. And it might seem minor and it might seem a little bit complicated, but the outcome is that you can sleep soundly from an investor's point of view that we're doing everything we can to prevent any losses in a project, as does Chris. You have a look at the work that Chris does on from a structuring point of view. He's actually trying to prevent an investor, because it's the investors that come in first. It's the development that he'll be fixing in terms of the taxation advice, but that in turn holds structure back right through to the investor to prevent them from from losing capital as well for unforeseen mistakes that might be stamp duty. Well, you lose a couple $100,000 in stamp duty. very easily, and only because the developer didn't go to getting the right advice in the first place.
I see. Good point.
All right. Well, it looks like the conversation can carry on, really. Well, like I said, this is just the introduction to the mini series that we're going to cover. And one of them that Peter's going to go through in a very detail, in the next coming series as well. But other than that, unfortunately, time is running out. Perhaps I can just put up the next slide there. Chris, you want to sort of have a final pitch on this one, especially the discount code there and all that?
Yeah, look, if anyone is interested in the masterclass, as we sort of said earlier, it does cover a lot of the topics, of these foundation topics around structuring and raising capital, etc., that a lot of other courses don't go into a lot of detail on. There is a special discount code there, which early bird is on, but this will give you an extra discount on top of the early bird. It's a 2-day course. You can see all the speakers there, obviously all leading experts in their particular industries and fields that sort of cover off on this. And yeah, look, I think we get a lot of experienced developers in who want to expand their knowledge into some of these areas. We get, I guess, developers in who have done a couple of small projects and want to take the next step. We also get aspiring developers in, someone who's done nothing as well. So it is a really good 2 days. If anyone is interested and wants more information, they can certainly reach out to either Peter or myself, but certainly that discount code there is for anyone to use who's been on the webinar today, which will give you that extra discount.
Excellent. All right, thanks, Chris. Tesla's going to put the link on the chat as well, so you can sort of go to the link and register today. Now, before we go, obviously, if you want to get in touch with Chris or Peter himself, please feel free to take the screenshot. And again, Tesla's going to put the link on the chat, or you can scan the QR code there with your phone. We'll take straight to the link as well. All right, I think that's almost come to an end. I'll put the next slide up, and then while we're making the final announcement, feedback is appreciated in terms of the next series of topics and all that. If you want to have anything covered particularly, please fill in that feedback form for today's feedback, as well as any suggestions on the topics for future series as well. That'll be great. All right. Other than that, I think that's coming to the very end. Thank you, everyone, for attending the webinar today. And thank you especially, Chris, for being our guest speaker and, of course, in the mini series to come. Thank you so much, Chris.
Right. Thank you.
Yeah. And thank you, Peter, once again, very insightful in a lot of topics. I was going to say this joke. Peter is the, what I call the trick of all trade and master of Capital Group. How's that? not master of none, all right? Master of Capital Group.
Thank you, John.
I think that comes to an end. All right. I think this is it. Any final words from Chris? We'll give Chris a special treat today. Any final words, Chris?
No,
before
thank
we
you. Thanks for having me on. Looking forward to the rest of the series where we can go into a lot more detail on some of these topics. So, really looking forward to that.
Excellent.
Great, excellent. All right.
Excellent.
Thank you, Tesla. Thank you, Chris. Thanks, Peter, once again. And of course, thank you, everybody, for attending our live webinar today. Well, have a good day. Bye.
Thank you all.
Thank you.